Hi everybody. Today we're going to be talking about notes payable. Notes payable are part of liabilities. In my first video, I talked about accounts payable. Accounts payable is probably the most common liability. When you buy something on credit, meaning you're going to pay later, you on your balance sheet would record an accounts payable. A note payable is a little different. Instead, rather than having bought something already and owing a debt for that, with a note payable, you are borrowing cash. And the note represents that, okay? But as you know, you can't really borrow money for free, right? What do you have to do? You have to pay interest. Okay, so today we're going to be talking about how to record the interest that accumulates over time and is ultimately paid out by you, by the borrower. Okay, so we're gonna need a few things here. We're gonna need a few numbers because in order to successfully record the journal entries, we need to figure out the interest owed, which means we're also going to need to know the principal, the interest rate, and the time period or time. Okay, so let's say that you borrow $100,000 and it's November 1st, 2019. Okay, that is your principal, right? That is what you're borrowing, and that's ultimately what you're gonna have to pay back with interest. Okay, so in order to figure out the interest, you start with the principal. The interest rate, it's going to vary. If you're in an accounting class, you're going to be given an interest rate almost always. Let's say, to keep it simple, our rate is 12%. And I say simple because this is an annual rate. You can already see that 12% of 100,000, that's 12,000. If we're saying that's an annual rate, then you know it's going to be 1,000 a month of interest. So I'll just write that out. So 1,000 interest that you're owing each month. Now, depending on the structure of the note, the structure of the contract, you're going to have, it's going to be determined in advance when you're actually going to have to pay the interest and when you're going to have to pay the principal, right? And the principal being the amount that you borrowed. Let's say in our case, the interest is going to be payable, meaning owed, on March 31st, 2020, and October 31st, 2020. Okay, so we have the principal, we have the rate, the time period. We've said that's going to be a year, but sometimes it's shorter, right? So if the note along with interest is going to be due, say, in 6 months, well, then you'd want to represent that as 6 out of 12, for example, right? But the assumption, or typically it's an annual rate, which means we don't actually have to do anything here because 12 out of 12, right, is the same as 1. So it's like multiplying 100,000 times 12% times 1. So we're keeping it simple. It's an annual rate, but just know that the problem could call for something else. So moving on. And the first thing that's going to be recorded is the note, is the principal, the amount borrowed, right? So remember, we're doing this from the perspective of you as the borrower. So you're getting cash. That's an asset. It's an increase, so we debit it in the amount of 100,000. As I've said, notes payable, that is a liability, and we are increasing it. I'll just mark this as NP, 100,000. So what this journal entry says, is you've received $100,000 of cash, and you're gonna owe that amount, right? Plus interest. So the interest is payable in 2 periods. Again, it could depend. It just depends on what the 2 parties agree to. But in this case, we're saying you're going to pay interest March 31st of the next year, because remember, this started November 1st, 2019. So you're going to pay interest March 31st and October 31st. And we're going to say for our purposes that you're also going to pay the note itself on October 31st. Okay, so I'm just going to say principal due also on October 31st. Okay, so we have all our terms laid out. We've recorded the first entry, which is you putting that obligation on the books. Now we need to keep track of the interest. Okay, so how do we do this? Well, if you've been watching my other videos, you can probably guess that the journal entry is going to look something like this. Interest expense, right? We debit an expense to increase it, and we said that interest is going to be payable at the end of March, but we're going to keep track of that interest. We're going to keep track of that interest every month. Okay, so I'm going to say this is the end of November. Okay, so interest expense is going to be 1,000, and we're keeping track of, just like we have an obligation to pay the note itself, the face amount of 100,000, right? This here, and represented there. We have an obligation to pay interest, right? And so that is going to be our credit. This is going to be interest payable. So as with many journal entries, this one affects the balance sheet and the income statement, right? So here we're going to affect, this one is going to affect the income statement, and interest payable, because it's a liability, just like notes payable, it's going to affect the balance sheet. Okay. So I guess one more thing I'll say about this. Interest expense, it's an expense. It's the matching principle in accounting is something I've talked about before, but the matching principle is very important. So with matching, the goal is to match revenues and expenses as closely as possible. So when I talked about depreciation, that was an expense, and that follows the matching principle, because the idea is, rather than recognizing the amount of your asset all at once, you allocate over time, because you're getting benefit or revenue from that asset over time. So sort of a similar concept here. You're keeping track of the interest over time, because as time goes on, in this case as the months go on, you're accumulating that interest, right? Because we said 12% annually, but this is being kept track of month by month. Okay, and then with these dates, this is when you're actually going to have to pay some of that interest, just as an example. Could be different dates, but understand the difference between actually having to pay the interest, which we're going to get to it. That's going to be our final journal entry, but you have to keep track of that. You have to keep track of the interest that's ultimately going to be owed, just like you kept track of the principal amount of 100,000. So you're keeping track of the interest, and this is how it's done. you increase an expense account, and you increase the payable, which is it's a summary account, kind of like accumulated depreciation was with depreciation expense. So this represents 1 month of interest. Let's look at T accounts because I think this should be helpful. All right, so we had note payable. Debit's always on the left, credit's on the right. So this journal entry here, 100,000. Interest payable, 1,000. So when I say interest payable is a summary account, don't let that confuse you. Remember, journal entries, what they do is they increase or increase an account. So you can think of T accounts ultimately as your summary, right? So you're going to have a lot of numbers here, and eventually that's going to that total is going to be the amount due, and that's what we're building towards here. This is how you would represent it in a T account. So we have November 31st, December 31st, it's going to be the same thing, right? So we've had, we're going to have that 1,000 expense and that interest payable 1,000 again, adding to the total. But eventually, it's going to come time to pay the amount. So we said that March 31st is the first time that interest is due. Okay, so if we're saying that that this company is going to keep track of its interest obligations each month on the books, right? We said that the journal entry is this. I'm just going to say IP for interest payable. So November 31st, December 31st. If this here is December 31st, we have 2,000 as the ending balance, right? And what do we know about the accounts on the balance sheet? Well, they carry over, right? So now it's 2020, and you have 2,000 in your interest payable account as the beginning balance. Okay, so this journal entry, again, if the business is recording it every month, maybe they don't, maybe they have another method of doing it, but keeping it simple, we're going to say end of January, 1,000, so representing, right, the month, right, that matching principle of representing real-time events. So record it when it occurred, right? That's what you should be thinking about when you're thinking matching principle. Record it to represent real-time events. In this case, the real-time event being the passage of time, just like with depreciation. Time goes by, and you represent what that means for depreciation expense in that case and interest expense in this case. So a month has gone by, so 1,000, another 1,000 for February, another 1,000 for end of March. So we started November of 2019, now we're at the end of March 2020. And remember what I said, according to, in this example, for this note, interest is first going to be due at the end of March of the next year. So we're here. So we've each time we've had interest expense of 1,000 and also interest payable of 1,000. It's time to pay. So for sure, so if we're doing the journal entry, you know for sure that you're going to have to pay 5,000, right? If we're just talking about interest, because that is the interest that's accrued for part of last year, right? The last 2 months, November, December, and now the first 3 months. So it's all of that. That's what this agreement looks like, right? So what is the debit? Well, we need to get rid of this liability. This liability has an amount of 5,000. So we debit it, and that would clear it. And so if you're looking at the T account, right, a debit gets you to 0. Are we done? What else is missing? We pay the interest, but what about the principal? Right, the 100,000. You can't just pay them the interest. You have to pay back the money that you borrowed. So that's just simply going to be, again, starting with the simple part, 100,000, 100,000 cash. And what do you think the debit's going to be? Well, just like we cleared this liability account, we have another liability account to clear, to account for the principal, the note payable. That is it. So remember to always go back to the accounting formula, see everything balances. It should. So whether that was the first part of the transaction, which was you receiving the borrowed funds, you had cash increase of 100,000, and the note payable increase 100,000, or whether that's the interest expense, right, and the resulting liability, or whether it's ultimately paying the principal or paying the interest, you should see that it balances out. So in the case of, we'll just go through this really quickly, in the case of the interest being recorded each period, so it's only going to affect the right side of the equation, right? Because we said, so first of all, the 1,000 interest each month affects interest payable, 1,000. How does it balance? Well, you have 1,000 going the other way here, right? And so that does balance because now the net effect is 0 on one side. So when you're talking about balancing the accounting formula, that could mean having the same thing happen on both sides of the equation, or having opposite things happen on the same side, which would negate them, right? So it's like plus 10 minus 10 in this case, plus 1,000 minus 1,000. It balances. There's no net effect. How do I know that equity is going down by 1,000? Well, remember, it's an expense, interest expense. Interest expense serves to lower your net income being the last part of the income statement. Net income goes into retained earnings. Retained earnings is your summary of net income or net losses over the years. And retained earnings is part of the equity portion of your balance sheet. And there you have it. I hope this was helpful. If it was, please like and subscribe, and I'll see you soon. Thanks.